it's going to be a shock to the system, and the reality is there's always a shock at some point. And when that shock comes out, it doesn't make any sense. If you look at the rally and you look at the data and you look at how it all, you go, that makes perfect sense. If you look at where we are today, that makes no sense. Other than, as you said, 10% of all these salaries go into pension funds, all this money's going to whatever. Now, what's going to happen to that flow when they're down 50%?
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kostrup-Larsen.
Welcome to another episode in the Open Interest series on Top Traders Unplugged, hosted by Moritz Seibert. In life, as well as in trading, maintaining a spirit of curiosity and open-mindedness is key, and this is precisely what the Open Interest series is all about. Join Moritz as he engages in candid conversations with seasoned professionals from around the globe to uncover their insights, successes, and failures, offering you a unique perspective on the investment landscape. So with no further ado, please enjoy the conversation.
Hello listeners, it's Moritz here, and thanks for tuning into episode number 7 of the Open Interest series on Top Traders Unplugged. Today on the Open Interest series, I have a really interesting guest, a short-term systematic trader who's been trading the markets for decades, but who's never appeared on a podcast before. His name is Tony Kaiser, the CEO and founder of Kaiser Trading in Melbourne, Australia. Tony began his career in 1988 at National Australia Bank, where he started the FX options trading desk and used systems to trade their prop book. 10 years later, in 1998, he left and launched his own company, Kaiser Trading. Kaiser Trading has been in continuous operation since more than a quarter of a century, and the firm had peak assets of about $2.2 billion in 2011. They trade short-term systematic strategies, a niche in the CTA space, given that most money is following longer-term trends. And that's also one of the many reasons I wanted to get Tony onto the podcast, because there simply aren't that many short-term systematic traders around anymore. You may know Crable and Niederhofer, and some of you may remember Amplitude and Baronia, both of which have closed down meanwhile. So that's an interesting space, and I'm sure it'll be fascinating to hear what Tony has to say about all the challenges, the opportunities, the ups and downs, and everything else. So without any further delay, Tony, welcome to Open Interest. It's great to have you here.
Moritz, thanks very much. I probably left one thing out of the bio. I actually was at Jardine Fleming, which was an offshore investment management company in 87. So I was a young guy back then and experienced the 87 crash. So I've seen a few cycles over the years.
Great. That'll make our discussion even more interesting, I'm sure. So to kick it off, I was in your office a couple of months ago, I think in November in Melbourne, and I was blown away by all the tech infrastructure that you had humming along there. I think it was essentially half of your real estate is service in your office. And I thought, look, we should have a chat. We've seen each other before, but I'd like to get you in the podcast. But before we get into the specifics and all the details, given that you are essentially a veteran of the industry with a longer than 25-year track record, I mean, how do you look at the space today? Is there anything, to open it up that you would say when you look at how it has developed and where we are today, anything that you'd like to get off your chest?
Look, it's been an interesting journey. From when I started back in 98, I was probably one of the first short-term systematic guys. Crable was around and still around. And as you said, Baronia, which was the Grinham brothers. And, Look, markets, we can talk about markets. I've been in markets now, 36, 38 years. They've gone through various cycles, and it'd be fair to say I think CTAs have struggled probably post-GFC from 2009 onwards. And having sort of lived through, 30-odd years of markets, if we look at, probably when I started at 98, if you look at where rates were, if you look at the movement of interest rates up and down, there was sort of increases, 88, 90, 92, sort of 2000, 03, 07. And it made for good two-way price action. And CTAs benefit, as in we're agnostic, whether we buy or sell. So effectively, let's summarise what a CTA is, right? We trade global currencies, global bond futures, global stock index futures, energies, metals, soft commodities. Effectively, for us, the liquid markets. And I think in the beginning, everyone or any investor is really just looking at what return do I get from that asset class, and then what diversification do I get from that asset class. And it would be fair to say the first decade, if you had invested in the S&P 500 or, stocks in general, from 98 to 08, you'd made no return. In fact, you had a negative return after the 08 crash. And I think at that point, we were probably up about 300%. And so it was an easy sell because if you looked at where you were going to get a return, it was an absolute return product that performed in 2000, 2008, and any time there was a crisis. And I think it would be fair to say post-2008, CTAs were flavour of the month. And so I think 08, obviously great for the industry. If we look at who our client base was, it was the large global fund of funds, sovereign wealth funds, the offshore pension funds, the large investment bank sort of private wealth units. And so being a manager in Australia has always been difficult because it's a long way to come, and most investors don't want to travel on a plane for 24 hours to see one or two managers when they can effectively go to New York or London and see the majority. And so the reason we probably got the assets that we did was obviously performance. I always look at us and any manager as almost like an English Premier League manager. You're good while you're winning, and they don't want to know if you're not winning. But the big thing why they came was the effect that we added to portfolios when you put it in. You considerably reduced the drawdown risk profile because we performed in those periods that they didn't. Come 2009, obviously the world, we can talk about it, but having lived through it, almost went under. And, the banking system was in crisis. There was systemic risk everywhere, and the central banks around the world put rates down to zero or close to zero. If we think of the Fed rate at, I think 0.25, I think from about February 09. And they kept them there. This is the thing that probably got me. They kept them there probably up until January 2022. There was a slight increase pre-pandemic. And if you think of the length of time they kept rates at nothing, it really meant that the carry trade, and when I talk about the carry trade, if you invest in equities, the earnings per share, dividend, whichever way you want to look at it, that's their earnings. And you're comparing that return against zero rates. And so it's a no-brainer. Equities are going to go up. If you look at the bond market, obviously the 10s, the 30s, the longer bond market, its yields were, say, 6, 7. Like if you think about rates in going back history, 82, rates were at 20%. And really you saw a 40-year decline in interest rates And then we saw a 14-year period of rates at near zero. And so effectively long-term bond yields kept going down as they approached cash. And then if we think of property, again, same story. So if we, and then obviously private equity, what are they doing? They're buying up businesses, packaging them up, looking to offload. So whichever way you look at the investor universe, it's long carry. And what I mean by that is any investment is going to be compared to the risk-free rate of return. Now, the thing that why investors would put CTAs in a portfolio is the downside protection that it gave in 2000, 2008, and you can even say in 2022. But if you were in a period of 09 to 22, where that downside protection, it costs you, and what I mean by cost you, even though we're short-term systematic, any models that sell in a market that's really got a floor under it by the Fed or any central bank, it's actually an unnatural market. And I would say the markets that we saw 09 onwards was almost like a Ponzi scheme. And from that, it sort of made it very, I would almost go detrimental to our space. It's interesting, here we are today, and we can talk about moving forward. And I always say investors invest by looking at their rearview mirror, i.e. what has performed in recent years and where do I put my money, rather than looking out the sort of windscreen of what are you likely to get in the next 10 years. And so it's interesting if we sit here today and you go, well, you've been doing this for 26 years, tougher time, why do you still do it? And I'd say I still do it for the pursuit of excellence and the love of the game, even though, if you, as you said, you talk about Amplitude, Baronia, a lot of these guys sort of made their money and shut down. I've probably made my money, but I still enjoy the probably intellectual challenge of the game, and we, as you saw, have gone shorter and shorter, sort of more into that minute space, interesting research. But if we look today, you've got US cash rates 5.5%. And so effectively, if you're an investor and you're going to invest in anything, you need to beat 5.5% against risk-free rate of return. And the beauty about CTAs is if you invest in a fund as compared to managed account, okay, you put the money up, but effectively 90% or 85% of that's sitting in cash. And so that in itself gives CTAs a tailwind of, say, 4.5%, 5%, which gets added to their return. Now, if you were to look at the returns of CTAs from 09 to 22 and add 5% per year, if there was cash, the returns would be quite considerable. And I did, listen to a podcast during the week where they said, what are CTAs for? Is it a bond-style investment plus? There is an argument for it, because a reasonable component, if there is interest rates, can come from cash as well as the return. And I think in that podcast, they talked about bonds not offering protection to a portfolio as in 60-40 and 22, because obviously if you've got interest rates going up, bond prices are going to get hammered. So, and again, listen to another podcast that they talked about 23 being disappointing for the industry. And it was. And I think, particularly that third quarter last year, I think took everybody by surprise given the setup of the market. But if we think about it logically, and even though we're Australian, I tend to be probably quite US-centric. If we looked at the S&P 500 and said its P/E ratio is around 30, that means the earnings yield per share is around 3% on those companies versus cash at 5.5%. And then in the NASDAQ, I think earnings per share is about 2%. Now, and again, if you're in markets, there's nothing wrong with taking risk, but are you being paid for that risk? And it's interesting now, if you look at where the market's priced, you're paying to be in the market. And that makes no sense to me at all. And you only have to look at 2000 and sort of 06, 07, when there was sort of negative carry in the equity markets to realise that either earnings are going to go up dramatically or there needs to be a repricing. Now, okay, I think third quarter or fourth quarter last year, they were saying, interest rates are going to come down, but it does appear as though inflation is being quite sticky, and there's obviously some confusion of whether interest rates will come down or not. And then, I think we only have to look at the geopolitical risks around the world at the moment. And I think it'd be fair to say globalization is deflationary and deglobalization is inflationary. So space is, I think, prime time. I think it's just given the factors that exist. And if, I was to look at alternatives, they don't look encouraging. I think the other reason why it's probably good is because this space has become unloved. So probably the amount of money in it isn't that great. Anyway, long answer. Have you got a question on that?
Yeah, absolutely. Quite a few. And thanks for that. Couple of things. You've mentioned you've been given money, obviously because of performance, but then also because your returns are uncorrelated to other things that, investors could invest in. You've also mentioned, I'd like to get to that some of your peers have closed down. You've mentioned Amplitude, Baronia. Whether they've made their money, returns have decayed, I don't really recall that. But when we look at your sector, the short-term systematic space, there really aren't that many managers in it relative to, say, the longer-term trend-following space. Let's just say it's half a dozen. All right, you maybe mentioned Altic or QIM, and you've mentioned Crable, but go down the list, it's a relatively short list. Why do you think is that? What is the main reason that space, your sector, is so, underpopularized relative to everything else?
Look, you have a lot of smart guys around the world that come out of some great university or colleges, and they think they understand markets. But when you get into the nitty-gritty of short-term trading, your impact, your market, as in your market impact, where you think you're going to buy and what you actually achieve, really, it doesn't matter what the strategy is. If you're, whether it's momentum, breakout, mean reversion, vol, whatever, effectively, if you have a good model, it's going to have about an 8% edge. When I say 8% edge, if you think of, if I tossed a coin, it's 50-50. If you're tossing a coin where if I win, I get, $2, and if I lose, I pay $1, I can be right 40% of the time to get an edge of 10%, right? So it's almost like a gaming theory formula. So, but effectively when we look at, you can play around with risk-reward ratios of what the model's trying to achieve. Effectively, 8% is around the number. And when I say it's around the number, we have the same models, same parameter set, regardless of the asset class. And so when I hear guys saying, I've got models for bonds and I've got models for stocks and I've got a model for this and I've got a model for that, my question is, why doesn't your model work on anything? And they would go, because it's a different time series. And I go, well, every time series will go through different regimes. And so our criteria to get models in is quite, I think, stricter. But then the implementation shortfall that can take place when you do that is quite significant. And I think unless you understand all the little nitty-gritties, I think it's a very difficult space to get alpha. Whereas if you're, just say, trend, effectively the market has some characteristics which we know trend is a factor, and it's not consistent, but, if the market's trending, it can do quite well. And it's a lot easier to create trend models than it is to do short-term models. And then the capacity limitations of short-term, like it's a lot more work. You're in my office, you see there's still a team of, 25 people. We're not, it's more proprietary money now, but it's still a big team for the assets we run, given the amount of work that's involved. And so I just think the complexities are high.
Is it your love for difficult things? You like to take the hard route to the finish line? Or maybe go down the memory lane, like when you started this 25, 26 years ago, and you compare it to today. So today you're co-located in London, Chicago, Hong Kong. I presume 26 years ago that wasn't the case. So when you maybe frame this, when you left the bank as a prop trader, why did you immediately move into the short-term space? I presume other options were available, but you specifically focused on that, the harder thing to do.
I think it all comes from where you come from, right? So, when I started, I ran the option desk. Okay, running an option desk as a trader, I think, is a very good learning ground. And why I say it's a good learning ground, you need to be quite strategic in thinking, okay, where do you think vol's going? Is it going up or down? You need to be quite strategic of, do you think the market's going up or down, and where do I want the vol or the gamma to be in my book? And then on the flip side, you're almost a spot trader trading the gamma of the book. And so you're combining, the way I look at it is a spot trader is like playing checkers, and an option trader was like playing chess, okay? And then from there, I sort of went on the pursuit of the Holy Grail to try and become a better trader. So anything, any book, any psychology, markets, you name it, I read it. And to just upskill myself. So I was a discretionary trader, as in running an option book, so I wasn't a systematic trader. And then you're a discretionary trader on multiple levels, from what's happening sub-daily, intraday, to where do you think things are going strategically. I was probably always drawn to the prop side rather than just running, say, the franchise of a book runner. And I remember, this is early 90 market wizards, Jack Schwager. I don't know if you read the books at all, interviews of top traders. And I sort of, if you could imagine, in Melbourne, Australia, nobody heard of the term hedge fund. And here was these sort of legendary traders. And I thought, I sort of had that idea in the early 90s. That's what I'd like to do. Because what happens in a big bank, you do well, trader, you run a desk, you then run the FX, you run treasury, and all you become is I'd say HR manager, as in running personnel. Whereas for me, the love was always off the markets. And so I thought, large, at that stage, they were the biggest Australian retail bank, but they weren't an investment bank, so the risk appetite wasn't significant. Not bad, but not, And I thought, I'll never get paid the money that I think I deserve. Maybe I had a delusion, but there was, in one of the books, I think his name was Van Tharp. He was a trading psychologist, and one of the interviews
unfortunately passed away 2-3 years ago.
Yeah, but he made the comment, and you got to remember, I read this 30 odd years ago, that most traders are delusional. Most traders don't understand their edge, and the only way you can prove that is to systemize the process. And I was sort of reading that, and I go, yeah, I think that's accurate. And so 30 years ago, I would say I was pretty good on computers, given the era, but I'd say 30 years later, I'm no good, and that's probably because I've got a team of programmers and quants that give me the tools that I work with. But anyway, I thought, okay, let me see if I can systemize the way I trade to prove my edge, right? And because you're at a bank that sort of wants daily profit, not a fund that's going to experience large drawdowns, it's got to be pretty consistent. The only way you could really achieve that was to be relatively short-term in focus, or make enough short-term to cover your more strategic bets. So anyway, it was a dilemma. So if you could think of in the early 90s, to get the data on markets for time and everything else was a problem. And anyway, I got this thing, it probably doesn't exist anymore. I think it was LIM, Logical Information Machine. Effectively, you had a massive database and you could sort of program it a bit and you could start to prove your edge. And even though I was a currency trader for the bank, my theory was that you could trade currencies, you could trade bonds, you could trade stock indexes, you could trade anything. And well, I don't think it was surprising. That proved to be the case. And so I thought, okay, I could see that I had an edge in my trading style 30 years ago. My mate Quan has still been with me all that time. I hired her from Melbourne Uni, PhD, mathematician, and I would say it's the longest relationship I've had. It's sort of coming up 28 years. I then sort of used this to prove that my ideas worked. But see, the next problem was, so I was leaving a big institution that had to pay for everything and going to go on my own. And I was like, okay, so how do I do this in a sort of a more low-scale budget framework? I thought, okay, can I take daily data and trade that short term? And because, again, minute bar, tick data, hours, wasn't the computing capacity back in that day. So I really adapted to using daily data to create the signals. And those models have held pretty true over that journey, which is a long time. Now, that's not to say that if we didn't evolve and didn't learn, we would have died, But it is interesting, here we are 26 years later, and now we're far more focused on minutes and combining that data in with what we do. And so I think it's just, I'm more of your trader's trader that is quant systematic.
Let's speak about that a little more, because that's an interesting piece you've just mentioned. I guess 26 years ago, you had daily bars, you were trading short-term systems off these daily bars, whatever, open range breakouts, or maybe you had some intraday stuff, I don't know. But I presume shorter-term trading back then was kind of slower than shorter-term trading today. I mean, maybe speak about that. Like how has trading frequency evolved? How in general do you need to evolve your trading systems? I presume also quicker than maybe some of the long-term trend following in order to stay, on top of your game.
I guess the time horizon back then was 1 to 4 days. If I had to say what it roughly was, probably came in at an average of 2 or 3, which you think is quite short term, but given where I'd come from, that was actually quite long term. And then obviously assets grew, over that journey quite considerably. And you probably tend to try and stretch it a bit. So because it's a function of where you enter to your stop, you can't be this elephant in the room to be able to execute and maneuver. So that itself had its challenges. In the early years, you could look at any style of model and we would know the periods where it's going to work and the periods where it's not going to work, and how can you fix the periods where it's not going to work. Like if we talk vol breakout, Vol breakout essentially works if there's a compression of volatility and the market's going to break out. However, it only works if you're in a moving state environment. So if you're in some of the markets, if we talk about JGBs, became untradeable, rates went to zero, nothing happened, you could say the criteria of the trade is present, but it's not going to work because the underlying dynamic of the market is not there. And even if you're quite short term, the reality is you can't fight, if we've got the markets going up for 12 years, doesn't matter how much you want to be a short seller, it's not going to work. Doesn't matter what your time frame is because the bias of the data. And, I would think today that there's probably a lot of hedge funds out there that have used the data the last 12, 14 years, and they're going to be making all their assumptions on what happens in the market dynamics. And I'm going to go, all those market dynamics won't hold true for the next 10 years because if you look at the really rate environment and its impact on markets, the effect of carry in any asset class is huge. And so if you've got 7-8% on a model and you've got negative carry of 3 or 4%, there's not much edge on that model left. What I'm saying is you've got to evolve. If we look at where we are now, there's so much information in the minutes to ticks to sub-daily that we are now very invested in harvesting that noise in our models. So, why do we do that? I think the only answer is I like it.
Is it, so it's probably more of a mean reversion style of trading than the majority of the risk that you're taking if you're harvesting that noise?
Yes and no. I mean, I always say to the guys, if you stand in front of a train, you're going to get run over. So the reality is, if you're going to trade the noise, you're going to be more mean reversion. However, if you're trading mean reversion into even short-term momentum or strong momentum, you're going to get slaughtered. So it's really a case of putting all those pieces together. One of the benefits of being in markets for so long, whether you say it's the intuitive feel or the knowledge of looking at the shortcomings in whatever you do is, if that makes sense.
Got it. If you look back at the models that you were running 26 years ago, we don't have to speak about the specifics, but in general, I'd be very interested in that. You had your models, breakouts, open range breakouts, vol breakouts, all of that run on daily bars. Are there any of these still running today, or is your space? Because the reason I'm asking, you could arguably say that, you have a long-term systematic trend following model, like a classic model that, you ran, say, in the mid-'80s, and you could still run that model today unchanged and it would make money because it's so long-term, it still works. Is there something like that also in your space where you say here, the open range breakout, expected hold period of 3 days. The way I traded it in 1998, we're essentially doing the same thing today and it works? Or is your space much more, no, we have to take things upside down, throw it out of the window, it doesn't work anymore, reinvent the wheel, do something new?
I think the answer is the characteristics of what work still work, provided the environment suits that. And I would say even for long-term trend following, the return profile in recent years has probably deteriorated from earlier where the markets were far more trendy in nature. And I think the level of noise, or what we call V-shape or W-shape price action, has become more pronounced. And I wonder if that's because there's more players in the system that are trying to do the same thing. But, dollar yen, when it took off a couple of years ago on the fact that US rates are 5% and yen rates are at nothing, essentially is a model or any model of old will perform well because it's in a highly moving state. If you looked at dollar yen for the preceding years, you would have had a pretty tough time making money out of that market. Now, for us, and it's probably in the modelling, which we then embed in the concept, understanding the regime and the phase is far more important than any model. Like, if you can understand the regime or phase, you know what model is going to work in that environment. Rather than go, I got a model and I'm going to run this on 50-odd markets and it's going to work all the time, I'm going, that's not true. That model will work when the market dynamics suit it. And therefore, the smarter thing is, can you understand what the market regime or dynamics suit the characteristic of that model? Like, that to me is that's the $1 million question, not the model. I think the models by themselves, people can come and see me and go, I've got a model that works, even external. And I go, you don't have to tell me the model. And I would give them the characteristics of this is the edge, this is blah, blah, blah. And they go, how do you know? And you go, well, that's what that model is going to give you. But the smart thing is, can you categorize the market regime to when to apply the model? And I think, to be honest, that would be true for trend following. That's true for short term. That's true for
pretty much anything. If you can, it is the $1 million question, but how do you do this? Is this discretionary?
No, it's not. Well, the concept, I think, comes from having the ability to look at the market and understand it. And I would say a lot of the ideas may come from a discretionary thought process that we code up and then try and prove the dynamic. And, look, hindsight's a wonderful tool, but, I probably had some personal issues from 2009 that maybe took me off the ball a little bit, and when the market dynamics really changed. And the fundamental dynamic that changed was rates went to was zero. And so the impact on that markets for that extended period, we still made money, but not as much, was huge. Now, the fundamental dynamics since 22 have changed, and so I think you would expect to see market behaviour more similar to the 1990s, early 2000s than what we've experienced in the past 12, 14 years.
So would you say that's a good environment for the, say, longer-term trend-following traders? Because recently they've hit it out of the park, so it seems to be a good environment for them.
No doubt. I think the move last year and, first quarter of this year has been good, really good for the long-term trend followers. The question I would ask is, how much are they going to give back on the reversal of trend in equities, potentially starting from now? You know what I mean? But the good thing for them is they will readjust. The way my description is, they're a cruise liner, right? So they will change course, turn, and if the trend persists on the downside, they'll do well. I would say a sudden change in trend right now is going to hurt, just given the way they're positioned. So the fact is, if you were to look at, we can talk about what's fair value of markets. If the equity markets halved, they wouldn't be cheap. Even if you look at, obviously good year for equities 23, good start to year 24. I personally don't think it's going to persist in 24. But if you invested in markets from the beginning of 22, you haven't made much money. And so I would think, if there's a reasonable downturn this year, then all of a sudden you're starting to look at 2-3 years, I've made no money. And that was, like, as I said, very reminiscent if you go from 98 to 08, where they've made no money. Now, all the index funds and, low-cost index replication, I think they're going to falter because the factor that drove those markets is not there. Like, I'll give you some examples, right? And because you got to go, if you sort of think about it and you go, well, how is this related to short term? And it's not. But I'm a markets guy, but you sort of want to know what's going to drive the markets. Obviously, Apple, Meta, Alphabet, Amazon, I wrote down a few others, Nvidia, Tesla, and then I put in some old school like Coke, Boeing, Walmart, right? So I don't think I've cherry-picked the names. The biggest phenomena, and I don't know if people talk about it much, is, and again, you talk about what drove equity markets and this whole index replication. If I can borrow money at 2% because I'm Apple, Alphabet, Amazon, Meta, whoever, Coca-Cola, and my stock's yielding 6 or 7%, and I just borrow and buy back my stock, I'm improving my earnings per share, and I've done nothing to improve my business, right? And so if you look at Coke, its sales in 2013 were $47 billion. Its sales in 2024 is $45 billion. So in over a decade, or just over a decade, my sales have gone down by $2 billion. So sales are not up. My earnings per share is pretty flat. I'm trading on a P of 24, and I've now got $40 billion of debt on my balance sheet that, I probably had 8 back then, and I've used that to buy my stock. Now, even if you look at a juggernaut like Apple, it had zero debt in 2013, and again, it prints money, but it's got $108 billion of debt today. And if you saw our graphics on, our tech, it's pretty good. If you look at a graph of these companies' debt going up and their number of shares outstanding going down, the correlation is beyond 100%. You know what I'm saying? And so every one of these companies has borrowed to buy stock, because if I'm the CEO and I'm getting my share options, I need them to vest, so I've got to get the share price up. It's a good way to boost my earnings per share without improving the company at all. Now, the problem you've got is Apple, if you look at its sales in the last 2 years, or, even EPS, it's gone nowhere. It's trading at 26, right? Meta is trading at 43. Alphabet is trading at 24. Amazon's trading at 60. Tesla's 37. It's been a juggernaut. But, the big one's Coca-Cola. We've got a company that's got no sales increase in over a decade, earnings per share pretty flat, and we're not talking about a growth company, and we're getting yet less than cash. So I understand companies trading at a premium because they think the growth. And then, the big question is, are valuations so sky high now that given, like, you got to look at, there's been a big change in dynamic. You've got rates going from 0.25 to 5.5 over a 2-year period. And okay, are they going to come back or not, or where are they going to come back to? But if I'm Walmart, we're not talking new age stock, and I've got a PE of 30, I've got, I'm earning 3%. And if I look at in 2014, my earnings per share was $1.74, and today it's $1.94. It's up 11%, but my share price is up 200%. It's gone from $22 to $62. And so, I'm sitting here going, I think the world's gone mad. And if the world has gone mad, that'll be good for CTAs. And
maybe this is also, a new regime in the sense that, you have these passive flows and price insensitive buying, corporate pension plans, like they come in, you get your monthly paycheck. Yeah, part of that, by definition, very automatically goes into an equity index ETF, very irrespective of price. So boom, there you just go. Price goes higher, number goes up. EPS doesn't matter. You just buy.
I've given this a fair bit of thought, as probably you have, but I think that's exactly what's happened, right? And it's going to be a shock to the system, and the reality is there's always a shock at some point. And when that shock comes out, it doesn't make any sense. If you look at the rally and you look at the data and you look at how it all, you go, that makes perfect sense. If you look at where we are today, that makes no sense, other than, as you said, 10% of all these salaries go into pension funds, all this money's going to whatever. Now, what's going to happen to that flow when they're down 50%?
Well, I don't know. That is the interesting question. 10% of the salary still goes into the equity index fund, probably regardless of whether it goes up or down. The question is what happens with the money that has already been invested in it?
Look, I think the world is sheep. There will, look, don't get me wrong, I thought the pandemic, so essentially we looked at factors that drive markets. Obviously GDP would be one. Unemployment, is is it a leading or lagging indicator, right? And generally if the market's up, as in the market's at high levels and unemployment's increasing, that's a good indicator that things are going to potentially turn down. And what I thought was going to get most of the people was the corporate debt, because the corporate debt, if you're borrowing to buy back your stock, let's look at Boeing as an example, right? They've got $54 billion. Now, if you look back in time, they're borrowing to buy stock. As a good company, did well. Obviously, pandemic hit, pandemic's been gone, that company's still not making money. Now, what you do know is, okay, it's a big company, it's probably too big to fail, but it's now got $54 billion of debt and it hasn't made money in 4 years or 5 years. Now, the other thing is when I need to refinance that debt as that falls due, there's a lot of free cash flow that's going to be taken up to fund, because if I'm going to fund corporate debt now, what am I paying? 7%, 6%, 8%? And I think just as they borrowed to buy, which gave this massive tailwind, you now have a massive headwind, because given the valuations, I can't see a corporate treasurer borrowing to buy.
It's too expensive.
Too expensive. And again, if you start to look at markets and you go, okay, if the tailwinds go out because it's not there, okay, what are the shocks that are going to, who knows? What are the shocks that are going to tip the system? Obviously Ukraine, Russia, it's been going on for 2 years,
Could be anything. This is the thing. We don't predict. We can't predict. Forecasting these things is an impossibility. It could be a thing that we don't think about today.
But the only thing I can say, though, is if I'm in the markets and I'm paying to take risk, that makes no sense.
Two more things. I think when we look at the longer term CTA space, where most of the money is, I'd say that on average, the correlation between peers is somewhere in the realm of 0.6, 0.8. It's kind of like if you're following longer term trends, one way or the other, you're going to be capturing that trend, which leads to relatively high and persistent correlation between managers. In your sector, the short-term traders, I haven't run the numbers, but maybe you know that number. I would assume that the correlation between you and other managers in that space is probably around zero. Is that fair to say?
Yeah, it's very, it's low. It has a low correlation.
So you guys are doing different things essentially, be that trading. And I would say it's probably not, wagering that guess, that you are trading different markets, because you don't really go into palm oil and sunflower seeds and milling wheat, because that would be too illiquid and probably too expensive for you to trade. The stuff that you trade needs to be super deep and liquid. So we're talking whatever the Hang Seng, the S&P 500, E-mini, the 10-year Treasury, all of these markets, but then every other short-term trader also trades. So the decorrelation comes from you guys running different models, doing different things at different times.
Yeah, correct. Like we've got about 30, just over 30 models trading all those asset classes, and now starting to go very short term into that. And so, yeah, look, there's a lot of different things you can do.
When you then have that low correlation between, so your return stream and the traditional asset classes, so your correlation to the S&P 500 is nothing, your correlation to gold is nothing, your correlation to oil is nothing, your correlation to the longer term CTAs and even your own peers is close to zero. That would make, or that does make your return stream a very effective addition to really any portfolio, regardless of what that portfolio is. So you would assume that just by investors looking at that return stream, because you have it in a database, they don't necessarily have to fly to Melbourne. It doesn't take much to figure it out to say, hey, I should be giving, some of my money to Tony Kaiser because it'll just improve the risk-adjusted return of the portfolio. So you guys should be running at max capacity, I would say, all the time.
Look, I think when I say we made some business errors, we got to 2.2 billion and closed, right? So no new investors. And what was funny, all the institutions are scared about a manager getting too big and taking on too much money. And at that time, they're going, oh, yeah, arrogant because you're not taking our money now. And I said to them, hang on, you are the same guys that don't want the manager to get too big. And so, it was a pretty good business. And, if you're not marketing and you don't have a pipeline because you think, okay, the money's sticky, that was the first mistake, because then post 08, sort of 09, the markets went into a bit of a wash, which made it difficult to make money. And a lot of the large fund of funds lost their assets, because of their performance, not the CTA performance in their fund, but their performance in 2008. We had a number of what I call managed accounts where they'd run leverage on us, right? And so if you're in a 5% drawdown, which is quite reasonable, but they've leveraged you 4 times, they're in 20, and if they're paying back then management fees 4 times, all of a sudden they're at 28% drawdown. And then all of a sudden they're sort of whinging or they're under pressure, Look, I think the reality was we were expensive for the reasons that we were uncorrelated. We did a lot to portfolios. Performance was high. I wouldn't say it walked out the door, but that's what it sort of felt like at that time. And then all of a sudden you've got significant investors with $300 or $400 million that are shutting up shop that might have had investment with Madoff or whoever. And then all of a sudden your asset drops by $1 billion, and then the universe is going, oh, what's gone wrong at Kaiser? His assets are gone down. You know what I mean? And then I think it'd be fair to say that when I say the dumb money, just the index fund replication, you had all the factors driving that, and people are going, we don't need to pay for alternate alpha. And I think that became the vogue. And look, you know, what was interesting, as an Australian manager, we never had any Australian pension funds, right?
Amazing.
And I think there was...
That's weird.
Yeah.
Almost.
Yeah. No. And at that point, you know, I think sort of, you know, 07, 08, we were considered, you know, I'd say, you know, number one, number two, you know, they're short-term managers globally. And, you know, we've got Canadian pension. We've got, a lot of assets from all over the world. And part of the problem was, I think from Australia, they wanted to travel to London and New York in their annual trip. What do we want a manager for in Australia? Which was ironic. But the world became fickle. And then now I think all the money is really controlled by the pension funds. And then the pension funds are trying to bring it internally and they don't want to pay for anything. And then you're like, well, we can't run that much money. It's expensive to run. Nobody wants to pay anything now because, you know, there's cheap, I don't know if you go cheap beta out there. And so we haven't marketed for, I don't know, 6 or 7 years. You know, like I'm just like, I'll just do this, stay in my corner. You know what I mean? You came in, everything's pretty relaxed. I do what I do because I like doing it, and we've got enough internal money to run. And I'm almost waiting for the world to turn, and then maybe people will knock on my door, maybe they won't. I don't really care.
You're enjoying the game. Maybe this is no, right. I think this is a perfect end to the conversation. Tony, thank you so much for doing this and joining me on the podcast today. I really liked it. I thought it was really interesting. I hope that our listeners will find it also. Tony, I'll put your contact info into the show notes. People can find you through your company website. I think you have a LinkedIn page. If they have any questions, I hope you wouldn't mind if maybe an email comes in and we get a question to answer. We'd always be very happy to do that. Listeners, if you like, you can also email us at info@toptradersunplugged.com, where we'll pick it up and respond. So, thanks everybody for listening, and until next time on Open Interest.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.